Okay, somebody say something really intelligent with the recording. It won't be me. I don't have anything intelligent to say. Okay, so we were going through finishing up discontinued operations. We were going to extraordinary last time, I think, right? Okay, and someone was kind enough to point out that, whoops, that 300 plus 500 is not 504. Yeah, anyway, yeah, so 200 less 800 would be the 19.2, so I don't know where that number came from. So, but I can't add it up. Won't let me change it. So, yeah, so anyway, well, maybe it would let me change it if I saved it and changed it. So, anyway, so we've got 500 or 800 there to make the 19.2. But we looked at this slide, I think, last time. And I think this is about where we were, okay? So, in fact, here they even say the line, don't they? Everybody see that? So they call it, they say discontinued operations are reported after income for continuing operations. Without a discontinued operations, this line would be net income. And, oh, they don't really call it the line. This is the line, though, right? What do I mean by the line? Taxes is right above it, so all these things are pre-tax. Every single one of them, pre-tax. What about everything that comes out? It has to be net of tax. That's it. What if it's a loss? It'll be net of tax what? Benefit. Because if you take a loss and you put it on your tax return and you're taxable, if you're in a 30% tax bracket, you put a $100,000 loss on your tax return, what's going to happen to your taxes? They go down by 30,000. So your loss isn't 100. What is your loss? It's 70. Right, guys? Everything's after tax. Okay, everything's after tax. What if I have a gain of 100,000 that's below the line? My tax would come out of that. If I'm in a 30% tax bracket, I'd take 30,000 away from it. My net gain is only 7. By the way, that's true on the income statement. What about if you go to the retained earnings statement? When we do prior period adjustments, they're going to hit the retained earnings statement, aren't they? Change in accounting principles also going to hit the retained earnings statement. When we do that, should those be net of tax or before tax? They're not going to go to the income statement, you guys. They're going to go on your tax return. Where do they have to? What do you have to do? Show them net of tax. They all got to be net of tax. Of course they do. Which things are not net of tax? Everything above the line, of course, right? Everything above income taxes. That's it. Okay. So you got the idea on that one. And oh, by the way, if I have discontinued operations and extraordinary items, which do I put first? Discontinued comes first. And here's how you can remember. There used to be 3 of them. It was DEC, I used Digital Equipment Corporation. Cumulative effect of change in accounting principles. Now we've changed that, and that goes on the retained earnings statement now. So now what I use instead of DEC, Digital Equipment Corporation, I use DEC. It's in Dr. DEC, right? It's in the order his name's in. So there's no logic to this. Why is discontinued first and then extraordinary? So you'll never forget that. Trust me. After you have it, you're never going to forget it. So what you can do is use TT, right? Discontinued first, then extraordinary, right? D comes before E in the alphabet. You know, that one would work. Okay. Anyway, there's no logic to it. Notice that we have to show both the operations, and it's from when to when? The beginning of the year up through when? The date you decided to discontinue the operation, right, guys? And then everything after that is wrapping it up and is considered to be part of what? The actual disposal, right? Because I'm probably laying off people, I'm selling off inventory at lower prices, doing all kinds of stuff, okay? Severance packages and so on. I said all that last time, I know. Okay, so what really happened here, how much, I said this last time too, how much was the income from operations before tax here, do you think? Somebody give me a number. 78.8. And then what they did was they took away the tax effect, tax expense in this case, 24.8, and they end up with 54,000 net, right? Because it's below the line, it has to be shown that way, okay? All right, and then now they have a loss on the disposal. How much was the loss really? 131, and then they took away the tax what? Tax benefit of 41, and they should call it applicable tax benefit and applicable tax expense, I think. I prefer you did that when you do one for me, so I know you know. Although I guess I'll know you know if you go the right direction on gain and loss. So the net is they have a loss on these two things, don't they? Now, if I were doing earnings per share, what would I do? Where would I start? The line, income from continuing operations, and then everything below that. And again, what do I call that line if I don't have any discontinued operations or extraordinary items? It says it right over there. That's net income, right? And we really don't usually call this income before income tax. We call it income from continuing operations before income tax. That's not really very good, right? So this would be income from continuing operations before income tax, and this would be income tax expense or provision for income tax. You can just call it income tax line. And then this is income from continuing operations. Everybody got it? So if you had extraordinary items, it would be even after that. And all those, it should be shown what? Net of tax. Everybody got it? It's pretty straightforward once you get your head around it, I think. So let's go on to that. This whole idea of intra-period tax allocation. Intra means what? Inside. Inter is between periods. So we do that too. Tax allocation between periods, trying to get in the right year. Okay, for the right quarter. We're doing quarterly statements. Okay, intra-period is allocation within the period. Where do we allocate it to? Well, what do you think? Some of it goes with income from continuing operations. Some of it might go with discontinued operations from operating, the discontinued operation. Some might go from the gain or loss on the discontinued operation. Some might go with extraordinary items, and some might go with what? On the retained earnings statement with prior period adjustments and with the change in accounting principles. So you'd allocate your tax on your tax returns, you could allocate it all kinds of different places, right? Plus, it's not really necessarily just the tax on the tax return because we have deferred income taxes on it. Okay, so we'll have to worry about deferred income taxes too. So what we really allocate is the total tax expense. And the tax expense could be tax currently payable and deferred income tax, right? Either an increase in deferred income tax or a reduction in deferred income tax. So we're really talking about the tax expense allocated. So like I said, income from continuing operations, discontinued operations, extraordinary items. Brilliant. Okay. All right. So here's an illustration of it, and they can show. Again, this is discontinued operations less the applicable income tax, which is the same kind of stuff. Same example. Okay. And this one is a loss, and it's the income tax reduction. At least this time we call it an expense and a reduction. Huh? So. Okay. Extraordinary items. Jackie's going to ask you this. Probably the first day of class. She loves this. Okay. So you want to be brilliant. So what is your answer when he says, what does something have to be to be an extraordinary item? What's he going to do when IRS is adopted? Retire. Okay. All right. So what's the deal? You know what Richard Schrader said about IRS? He hopes they wait to adopt it until he retires. I like that. And back in, I was teaching this stuff back before 2010. Yeah, it was. It's been a long time because they were going to have it all adopted by 2010 and all implemented, you know. And so Richard's thing was, no, I don't think they'll adopt it until I retire. At least I hope they don't. Because then you don't have to learn it, right? Yeah, sure. It's just your problem, guys. Things constantly change. Don't worry about it. Things. By the way, you're not the first group of new accountants that have to learn new stuff. It constantly changes. It moves. So imagine when they ceased having the ATD and switched to the FAST. It is rough for everybody. Oh, that's when I got out of school, right? Back then. When did the FAST start? 73. I graduated December of 72. There you go. Oh no, we don't do that anymore. We do this up. You know, same knowledge. It's still got. You just keep learning. So you learn how to learn while you're in school, but you just keep learning, keep learning, keep learning. We have to be continuing professional education here for your guys. That's not very college. That's college. But you actually form for 8 hours a year. So for the rest of your careers. Okay. Anyway, so what do they have to be? What are the three things? Unusual and infrequent, right? So unusual, what does that mean? Unusual for the business that you're in, right? And infrequent for you, okay? All right? And then it has to be material. Everything has to be material, right? So materiality there too. If they're not material, you get away from this. You don't have to worry about it. What does that mean? If it wasn't material, I'd put it up where? Either under operating or under non-operating, right? In fact, they had discontinued operations that were not material where they put them. Show you examples of that. It was either not material or it wasn't a full segment of business, so it's not as material as being a full segment, right? So where would you put it if it's not a full statement of business, not separable from business? Where does it go? Yeah, other gains and losses, which is called non-operating, going non-operating with you guys. Okay, that's where you put that. Okay. What about an extraordinary item? It's not extraordinary because it's either unusual or infrequent. It's just one or the other, so it's not extraordinary. Where would you put it? It's an unusual item or an infrequent item, and it's still material. Probably non-operating, right? Sure. If it's real material, who cares where it goes? It's tiny, it can be up under operations. Okay, so the company must consider the operation, the environment in which it operates. Example I like to use of this is if you have your building. Well, let's think about down along the Ohio River. This works good. There, along the Ohio River on the Indiana side. Actually, there's one on the Louisville side too. The restaurant is on the river side of the floodwall. Anyway, you guys aware of that? Which restaurants are on the river side of the floodwall?
Yeah,
Tumbleweed. Yeah, Tumbleweeds, I think. What else? Joe's Crab Shack, except Joe's Crab Shack is up on stilts, right? So they've done something about it. And you know what? That building is high enough on those stilts to be above the flood wall. So if they close the flood wall, where's the water going to go? Over the flood wall instead of into their restaurant. But because their restaurants still get hit by debris and stuff, have all kinds of damage. Yeah. How about on the other side of the river?
Buckheads.
Buckheads, it's below the flood wall. Yeah. Is Chili's on that side? Okay, yeah, okay. And then there's also the fish wells. Kingfish over there. They actually get damaged if the water comes out. They can get wiped out if the water goes out of the flood wall. Because they're going to sure get flooded because they're going to flood the flood wall. Let me ask you this. If they have damage from floods, is it an extraordinary act? Nope. Fine. How about if you're on the other side of the flood wall, and the flood wall is closed, it's a 100-year flood wall, and you get flooded? That's extraordinary. What do you think? Infrequent, unusual? You planned against it, right? Got the idea? Okay, so there aren't very many extraordinary acts. They tell you in the book that, what was it, did you guys read this thing? Yeah, right. What's the deal with 9/11? What happened?
Yeah, it wasn't considered extraordinary because it happened to so many companies at the same time.
Yeah, it happened to everybody.
Yeah.
The loss happened to everybody. Also, it would be really difficult to measure the loss, to separate the loss. People would take advantage of the loss. Anything that went wrong in the company must have been because of 9/11, right? So it's just there was no extraordinary act. It happened to everybody. So let's hope it's infrequent. But was it unusual? No. Happened to a whole lot of companies, right? The ripple effect throughout the economy was huge. Okay. Plus, lots of companies had operations there in New York City, of course. Okay. And they were doing business with people in New York that affected their business and all kinds of things. Okay, so way to think about it. Under IFRS, what's the deal with IFRS on extraordinary companies? It's not GAAP. It's not allowed. They think we're crazy. I kind of agree with them on this one. Okay. They should be very, very, in fact, there it is. It's prohibited under IFRS. How about that? Okay, so tell me if these are extraordinary. A large portion of the tobacco manufacturer's crops are destroyed by a hailstorm. Severe damage from hail storms in the locality where manufactured grown tobacco is rare. They said it was rare, so guess what you get? Yes. What if they happen a lot? No. Okay. A citrus crop, grower's Florida crop is damaged by frost. By the way, you have to know something about climate, something about the industry you're working with. You guys know enough about citrus crops in Florida? Do you know that they have frost in some areas every single year?
And one frost kills the entire crop.
And a frost will wipe you out. So your neighbor might have a frost and their crop's gone, you still have yours, you have a good year. Because they got wiped out. Next year it might go the other way. Yeah, really? Okay. So what you try to do is you like to have land in a whole bunch of different areas. And most crops are this way, by the way. Weather can just wipe you out. You have it in a whole bunch of different areas. So if some areas get hit, you don't lose everything, right? So, yeah, anyway, so it's just a normal cost of business. You expect this, no. Company sells a block of common stock of a publicly traded company. The block of shares, which represents less than 10% of the publicly held company, is the only security investment the company has ever owned. Makes me real uncomfortable. They always try to come up with something that's extraordinary that we made ourselves. Do you think this one's extraordinary? It's 10% of the company. Well, fine. I don't know that that matters too much. But it's the only one we ever held. Didn't they buy this and hold it and have the loss because of a decision they made? Yeah. Would that apply to extraordinary? No, but how about that it's the only one they ever owned? Maybe?
That's stretching.
I don't like it. They say yes, I say no. My professional judgment, the honest professional judgment. That's the way this works, you guys. I would think, that's not extraordinary. Come on. You bought stock that went down in value last month. You don't get an extraordinary amount of value. You just have. You made it happen. It's your fault. A strike is a strike extraordinary?
Depends on if it's free.
No. Strikes are free, not unusual. Stuff that might be frequent for you, but they're not unusual. People get struck. And you could have done things to avoid it. You could have given what they want.
Oh, yeah.
Yeah,
That's true.
you could have better relationships with the union, all kinds of things, right? So it's just the cost of doing business. It's the cost of doing business. They used to use the example of, what if you had a major customer and they go broke and 40% of your accounts receivable become a bad debt if you didn't anticipate. I don't think that's extraordinary. I think it happens. Not all that unusual, unfortunately. It's better not to have a customer that you owe 40%, right? That owes you 40% receivables from one customer. Better not to have that. But you might have that just because of the nature of your business. But it's a risk of doing business. So I always disagree with that one too. Nah, that's not extraordinary. It's a bad debt. Come on, people have bad debts all the time. It's just a big one. Oh well. Okay? You're going to have to use your own judgment on this. And here's the rub. On the CPA exam, you have to guess what they meant. What would be the key on this one? The only one they ever owned. Everybody see it? So we say yes, because it's the only one they ever owned. What if they had a number of investments like this over the years? Then you'd say no. Got it? Okay. Not much help on it.
To report something as extraordinary, like, it has to meet this criteria, obviously. And all they have to do is, like, if the internal accountants of the company and the auditors decide it's extraordinary and you can report it as such.
Then it is, yeah, but you'd have to fall down. So it has to be both unusual and infrequent.
Okay, but like,
So
what
your integrity.
if you were to report those, send the financials to the SEC and somebody at the SEC says this is extraordinary?
Well, then you'd have a problem. Yeah. If it was clearly not extraordinary, if you made it extraordinary, the SEC would object. Absolutely. Remember, the SEC is not funded very well. So the odds of finding it is pretty slim. So who's it up to? It's up to the management of the company, right? The accountants working at the company, and it's up to the auditor to make sure things are reported properly. Public trust you guys. We're a profession, right? So can we lie to get away with it? Yeah. So don't. Right? Because you know it's kind of thing. Yeah. You guys, do you, is the reason that you don't go 120 miles an hour down the freeway because it's illegal or because it's unsafe? And it's therefore unethical and probably immoral to put everybody's life at risk. What's the reason you don't go 120 miles an hour? Because you're going to get a ticket or because you're, sane? I hope it's because you're sane. They don't need to have a speed limit to keep me from endangering other people, right? They don't need a speed limit at all. I think where there are school kids, I go really, really slow. I go lower than the speed limit over by Assumption High School. You guys ever drive by Assumption when they let school out? Oh my gosh, you need to stop, right? I mean, I'm crawling along. I don't like to be in the lane where the kids are. Those girls are crazy. They just got out of school, and they're having fun, and they're with their friends. They don't know where they're going. So why do we go slow? Because it says to, or that reminds us that it says to, and it's a flashing light. But the real reason we go slow, of course, is because we don't want to run over them, okay? So why do you tell the truth in financial statements? Because people are reliant, not because you might get hot. And I'm not saying you imply that you did not, okay? But are there disreputable people who might try to do it? Yeah, absolutely. Would you like to take a big loss and make it extraordinary instead of ordinary? Absolutely. Would you like to take the bad news and put it in non-operating instead of an operating? Absolutely. Put the good news up under operations, and the bad news in non-operating, or if you can, put it in discontinued operations, or put it in extraordinary items, right? Or better yet, put it as a prior period adjustment on your retained earnings statement and have it never hit the income statement. You like that? Let's say it for next year, and then we'll claim that we're correcting an error, and it never runs through the income statement at all. And see how people can manipulate their statements, I guess. Okay? So this is the real stuff that we get down to. You know what's fun is when you go out and you start auditing companies, everybody's looking at the detail of, oh, was this transaction right, was this one right, did they record these things right, are all the accounts stated at the right amounts and all that, right? And then when you sit around at the end of the audit, you start to ask yourself, do these financial statements tell people what's really going on in this company, where they're at and what happened? Are we really being truthful here, right? Is the client telling the truth, right? Is this real? What are the major things? And then they're huge, they're big numbers. You know, you're kind of like, well, I'm not sure that they've earned that revenue yet. I'm not sure they really completed the process. Or I'm not sure allowance for doubtful accounts is big enough. We might be off by $500,000 on the thing. What's the journal entry for increasing your allowance for doubtful accounts to $500 million? Debit what? Credit the allowance and debit what? And the debit to bad debt expense does what? Reduces your net income, reducing your retained earnings, reducing your equity. And the credit to allowance does what? Reduces your assets. And all of a sudden, you're not as good a company as you used to be. And your net income might now be negative, right? You get the idea? It's the big stuff, okay? And that's where manipulation can be too, of course. Okay? Same thing on inventory. You know, whether the inventory is valued right or not, you know? What if people intentionally overvalue their inventory? What just happened? You debit inventory and credit what? Effectively. Where does it end up? Cost of goods sold is less, net income's more, equity's more, assets are more than they really are. And of course, you lie in your financial statements, and people are relying on them, right? Making investment decisions. Probably the only thing some people care about more than their children is their money. Hopefully, most of us care more about our children than their money, but it's certainly second. Well, dear God. Okay. All right. Are these extraordinary? A large diversified company sells a block of shares in its portfolio, which is required for investment purposes. They're making investments on purpose, right? Large diversified. Portfolio of securities. They have a whole bunch of them. What do you think? No. Yeah. An earthquake destroys one of the oil refineries owned by a large multinational oil company. Earthquakes are rare in this region.
A bit more information.
Yeah, what does rare mean? We have a lot of oil refineries. They say yes, right? But having a lot of them might make you think, well, you're taking a risk. But they're rare in this location gets me to yes, I think. What if we're in an earthquake zone? No, right? Okay. Company experiences a material loss in the repurchase of a large bond issue that has been outstanding for 3 years. The company regularly repurchases. No. Okay, got the idea. So they give you some keywords in there. Usually on a repurchase of a bond issue, I wouldn't think extraordinary. Right? I'm making that happen. I made the decision to do it. Okay, so how do you handle extraordinary gain? And what's really nice about this is it really looks a lot like the discontinued operations, doesn't it? Notice they've got income before. Oh, this is another way you could do it. You could either call it income from continuing operations, or you can call it income before extraordinary item, or income before discontinued operations, or income before discontinued operations and extraordinary item. I personally prefer, it's just personal preference, I prefer continuing operations, and then make it always be that. But this is fine. And then you take away the income tax and the income before extraordinary item. So they kind of show it to you both ways, I would say. And then here, this is a gain, so guess what? You're going to have tax on it. So here we have condemnation of some property. The government did it to you. Hopefully it's infrequent. It's relatively unusual. Okay, so you get, certainly unusual, I guess, so. And so you get a loss here that you're going to have to treat as extraordinary, and they show the applicable income tax. They're assuming a 30% tax bracket. By the way, is tax bracket always 30%? Of course not. It's whatever it is, right? 40, 35, whatever the company is. Okay. So anyway, so we've got the net income. Everybody good? Looks exactly the same, doesn't it? This is the company. this as a loss instead, and so it's a tax reduction. All right? Everybody see it? See how to handle it, how to report it. Okay, so now we've got a nice complicated one, right? Extraordinary items are reported after continued operations and after discontinued operations, if you have it. If you don't have discontinued operations, don't put it in. And you can see that we put the discontinued operations, the income, right, from the start of the year to the measurement time, right, the measurement date when we decided to do it, okay, and decision date. And then the loss of the disposals here, okay? And both are net of tax. And then we have the extraordinary item, also net of tax, okay? And we have one more piece. Minority interest to worry about. So we'll hit the first two. So first, we'll do that in a second. Irregular transactions such as discontinued operations and extraordinary items should be reported separately where? Which one do you want here? Oh, like that? Okay. Doesn't make any difference if you see what's happening. Discontinued operations and the extraordinary items are still separate. Everybody got it? It's still net of tax. Alright. Okay, and this is the one we already talked about, I think. Yeah, this is the terrorist attack on the World Trade Center. And they say the measurement would be of possible loss was too difficult is the reasoning they used, and I think that's true. But also I think it said it happened to everybody too. Right? I think it's both. So yeah, after much deliberation. The Emerging Issues Task Force, you learned about them, right? Already? Right? Of the FAS, we decided to measure the possible loss was too difficult. And so that was the decision that was made. We're not going to report this. It's extraordinary. And can you imagine what a big deal this was? Everybody's wondering, well, what do we do with this thing? Okay. I heard a thing this morning on NPR, just really briefly, about mesh filtering, about the FASB is working on a project where we are going to suggest that companies disclose the risk that they have from global warming. And what they were talking about specifically was flood. Because the reality is they were talking about, one example was in North Carolina, Newport News, that was the town called, where the military base was there. It floods on a continuous basis now. The water in the last 100 years has come up 12 feet. And so now it's all kind of underwater. Talk about what they're going to do to keep the base there. Put up a flood wall. Actually, really, obviously very expensive. But all along our coastlines, apparently, we're going to have to do something about flooding. So we're building buildings that are taller. We're raising buildings up that already exist. Historical buildings are a real big problem. Move them. It's going to get destroyed. And we're putting up flood walls. And you're just doing all kinds of things, right? Changing construction. The equipment inside manufacturing plants they're putting higher. They were talking about the shipyards. They're not going to move the shipyards. They're raising the shipyards. It's just water keeps getting. Well, otherwise it's going to get water. Okay, so they want companies. The idea is the FAS is going to work on having companies disclose what the future costs are going to be. Risk, right? Maybe the risk of global warming. So, and of course, what's the impact going to be on the economy worldwide? You know what's kind of sad about this is all this is really horrible and it's doomsaying and everything, but you know what? It's economic opportunity. A whole lot of people are going to make a whole lot of money because of global warming. There's going to be a whole lot of suffering, a whole lot of pain, maybe a whole lot of death. But a lot of people are going to make a whole lot of money. There's going to be a lot of economic development. Anything that gets destroyed has to be replaced.
Not to mention
new ways of doing things. You know, we're going to, maybe the whole world is going to look like Holland, right? We'd be underwater if we didn't have the dike, you know. So, I don't know. Yeah. We'll see. What I'm hoping is, you know, like land on Lake Cumberland is really going to be waterfront. I'm up right now. I'm way up above the water. I'm hoping the water levels can come way up. It's going to be right next to me.
Hey, there you go.
And stop. And then stop. Yeah. That's terrible. There'll be winners and losers. So anyway, I think it's kind of cool. The FAS is involved in that. So maybe that's something that's coming. It won't be in your CPA exam at that. Okay, then we got the last one, the non-controlling interest. When a company owns substantial interest, generally greater than 50% of another company, it requires what? Consolidation. So then you don't have this issue, right? Because you combine their revenues with yours, you combine their expenses with yours, you got combined statements, you wouldn't have, you wouldn't have to worry about that, right? Except the piece that you don't own. Oh, you do have that. You combine them with you. If you own 100%, you're fine. But what if somebody else owns part of it? Well, then those earnings aren't yours. So this is pretty cool. What does it look like? So here they got an example. Coca-Cola owns Coke, huh? But anyway, Coca-Cola, they don't really own the Koch brothers. That's probably not true. Coal guys. Anyway, say they own 50%, it consolidates the financial results, and so then what they've got is their consolidated earnings from all the companies they own, their company and other companies, is 8 million or whatever it is, 634, less the income attributable to the non-controlling interest is 62,000 or 62 million or whatever it is. Okay, so the net income attributable to Coca-Cola is the difference. It's not an expense or a dividend, it's just an allocation of income. So you let your shareholders know what their share is, that's all it is. Okay, so here's what it looks like in the statement. And now, remember I said that if you have very many things going on in your company, your income statement from continuing operations here's income from continuing operations, the line. This part is just as short as the rest of it, even before we do earnings per share. And how many lines are you going to have earnings per share on here, you guys? You're going to start with the 276 and then do every line after that. Your earnings per share disclosures are as long as this part down here. So a third of this statement is earnings per share. A third is discontinued operations, extraordinary items, right, and the minority interest share. And only a third of it is your operations, and your operating and non-operating. So there's the non-controlling interest down there. That's lovely. I would know this chart. Is it illustration 417 in your book? I know this. I really know this. If I asked you an essay question about this, could you answer it? And I already talked about all these things, right? We don't need to spend any time on it, I don't think. We talked about it. But could you do this? If it's unusual, maybe we'll talk about it. It's unusual gain or loss, not considered extraordinary. It's unusual or infrequent, but not both. Where do you put it? It goes in non-operating, right? So look, it goes up above income from extraordinary items, right? Often reported as other revenues or gains, non-operating activity, right? That's where it goes. Not shown net of taxes, before tax. Why? Because income taxes comes after it, right? Everything above the line is pre-tax. Okay, examples, write-downs of receivables, write-down of inventory, adjustment of contract prices, gains or losses on foreign exchange, gains or losses from sales of assets used in business. Okay? Now, discontinued operation, it has to be what? Clearly distinguishable from other product lines, right? It could be product line, it could be a region, but clearly distinguishable from other operations and cash flows. Okay? Sale of a diversified company of a major division, a particular industry out of, or maybe a region of the country you're out of, or a region of the world. How do we do that? Immediately after income from continuing operations. So again, you have income from continuing operations, income tax, provision for income tax, and then you have net income, right? Income before tax, then you have net income from continuing operations. First item is discontinued. You show the discontinued how? Net of tax and two parts, one from operations, the other from the gain or loss of disposal. Okay? By the way, you haven't really disposed of it yet, and you're going to have a loss next year when you finish disposing of it. You estimate the loss in the book. Right? What if it's a gain next year? We're conservative. We don't book it. We put 0 for the gain or loss. We think we're going to have a gain because the gain hasn't happened yet. So because we're conservative, we go ahead and recognize the loss, even though the deal's not going to be completely done until next year. Can you imagine that you decide to shut it down and you're not going to completely shut it down by the end of your year? Sure, it's a year going to get it, right? So if it's a loss, you estimate the loss, and you go ahead and book the loss. Okay? And then a tax. If it's a tax. And if it's a gain, what do? Show 0, right? You can only go to 0. Right? Everybody got that? So you can't have a discontinued operation with a gain if you don't have a gain. But yeah. anyway, extraordinary items, material, unusual, infrequent, and it's going to be shown where. I get some examples. Major casualties, expropriation. Right? Okay. So things changed, I think. Oh, by the way, that's interesting. What if you have a, I don't know, you have your business in, Canada, and Canada becomes communist and take over your business. Extraordinary. Absolutely. Unusual and infrequent. Absolutely. You establish your business in a really poor country. It's called third world countries, but they're a second world now, so yeah, third world country. And what we call the terrorists take over, right? That's what we consider right after they're different. Okay, they take over and hate Americans, and they nationalize your business. Extraordinary. I don't think it's not the correct political climate. I think it's just a risky trade. You probably make a whole lot of money if you start a business in Afghanistan, right? Make excess profits due to their political unrest, maybe. Right? It's a risk you took. Everybody got the idea? So that probably wouldn't be extraordinary, even something as extreme as that. So, okay. All right. And then so obviously, oh, by the way, where does it go? After the discontinued, we beat this to death. Okay, that's good. Non-controlling interest, allocation of net income divided into two classes, the majority share and the minority share, and we show the minority share separate, right? Net gain or profit or loss is reported after net income, right? Okay. The number you really care about is the real net income, probably, including those. Send the message. Oh, and on that one, do you have to show earnings per share on that? Those last two lines? The answer is no, not required. Okay, it says it one looks like a job, so it's not required. So there'd be a cool question about the CPA exam. Huh? It's not required for those, but people show it still. Okay. You don't have to. You just have to have your regular net income. Okay. Strange thing. All right, earnings per share. Here we go. Why would we subtract the preferred dividend from the net income? Because it doesn't belong to the voting shareholders, right? That's it. So we leave it out of the earnings per share. The preferred dividend is the earnings for the preferred shareholders, right? Everything else belongs to the common shareholders. So what you do is you take net income less the preferred dividend. Because remember, the preferred dividend is not an expense, right? So it didn't reduce net income. It's not an expense, okay? So that's their share of the dividend. So the rest of the net income belongs to the common shareholders. That's all. And we divide it by the weighted average number of shares. Because you might be issuing shares and buying shares back as treasury stock all through the year, right? You'd be doing both. So we take a weighted average of how many shares are out there instead of just using year end or the beginning of the year. And they say it's a significant business indicator. A lot of people like to use it. It's fine. Measure the dollars earned by each share. So you take the number of shares you have times that. That's your share of the earnings. That's fine. Okay? And it must be disclosed in the income statement required. And this disclosure's got really big. So here's an example. It's pretty simple. They just gave you the net income, the preferred dividend, the number of shares. Guess what? You got it. Big deal. But here's what we really need to know. Okay, look at this. Like I said, and I used the same example. From the line, income from continuing operations, and everything thereafter, what do we do, you guys? Well, everything after that's going to be net of tax. That's true. Okay, because these are pre-tax up here, and then we have the tax, right, guys? So that's after-tax net income, right? Continuing operations. And then each of these items down here are net of tax. But for earnings per share, what do we do? We start with the line, we start with the line, income from continuing operations. Don't click on it, please, just point at it, okay? So we start with the line, income from continuing operations, and everything thereafter, notice they showed earnings per share. Everybody got it? So they made it the math simple. What was it, 100,000 shares? If 276,000 is 276, and the 54 is 54 cents. Got it? Showed every line. Safe is just to show every line. They don't necessarily do that. So I've seen them where they wouldn't show on both of these, so they'd only have, instead of having both of these, they just have one. It's okay. Show every single line. Got it? Can you do this? Pretty simple. And, oh, by the way, we'll have a later chapter where you have to do, these are weighted average number of shares. There's also equivalent shares. It's a what-if shares. And you'll do that, I think it's in 212, okay? What we do is we say, what if all the stock warrants, what if all the stock convertible stock, debt is convertible to stock, what if all these things are exercised? All the possible ways that you can have common stock are exercised. So it's a what-if picture. So if all these things were exercised, how many shares of stock would there be? So you have what's called fully diluted shares. So it's more shares, and then you show the earnings per share for that too. So the earnings per share disclosure gets even longer than this. Okay, for companies that have those things. So anyway, for now though, I'll keep it pretty simple. I'll just tell you the shares there are computed. Okay, maybe keep an average. Maybe put the preferred stock in there too. Preferred dividend. Oh, cool. All right. This is kind of an interesting thing, I think. What do the numbers mean? So here the FASB and the IASB, International Accounting Standards Board, are working on this joint project relating to the financial statements. It's kind of interesting in IFRS, they put the non-current stuff first on the balance sheet and then the current stuff because they think the non-current is more important. I guess that's why they put it first. They always have, so they do it that way. We've always put the current first. They might be right, huh? What's more important in a business? Their non-current assets or their current ones? I guess it depends on the business. But yeah. The service industry might mostly have current assets, right? Versus the manufacturing industry might mostly have non-current assets. So I don't know. But anyway, they have a flip-flop. So we have to decide how we're going to do it. Right? Those kinds of decisions. And some things are more substantive, some things are less substantive. But this is interesting. They asked financial statement users, preparers and users, right, what they preferred to use to make decisions. And this is interesting, isn't it? Net income's only 10%, like that measure, right? What's EBITDA? EBITDA. Earnings before income, taxes, depreciation, and amortization. Oh, so they don't think depreciation's a real expense. They don't, and actually under IFRS, taxes in Europe in general, taxes are considered an expense in the sense that they're a payout to stakeholders in the sense that you're supporting government. So one of your functions as business is to support society, right? To pay for society. So the reason you're earning profits is for your shareholders, but it's also for society as a whole, and that's what tax is. So tax is not an expense. Tax is a distribution to stakeholders, which it is, right? So, and some people think interest is the same thing, right? Okay? So before interest, taxes, depreciation, amortization is what that is, okay? So yeah, so interest is a return to the stakeholders who are debt holders. Yeah, kind of. Well, that's a much bigger number, isn't it? Right? But this number is much bigger than net income, of course, and 27% on that. Comprehensive income, only 6%. And remember I said, you really got to look at those other comprehensive income items? Only 6% like comprehensive income, 10% like net income, 27% like EBITDA. Operating income, 31%, real common. So can you see if 31% are using operating income, why people would like to put the bad news in non-operating income and the good news in operating income? Get my drift on this thing? All right. So manipulation. Okay. And this is earnings before interest and taxes. They left depreciation in. So that was 13%. So this category down here is huge. That's the point that they make. It's almost all of it. So, okay. Anyway, ways that people are looking at income. So it matters for disclosure, doesn't it? Okay. Reporting of accounting for changes and errors. So here we go, right? All right, what's an accounting change and what's an accounting error? An error is a mistake. I made a mistake last year and I got to fix it. We're going to call this a prior period adjustment, okay? If you made a mistake in either revenues or expenses, either overstated or understated, gains or losses, you made a mistake in a year, where does it get closed? All the revenue expense accounts, gains and losses accounts go where? Retainers. So where's the mistake? When you do the next year. It's in the beginning balance of retained earnings. So guess what you adjust? tax. If depreciation expense should have been less, what'll happen? You had more taxable income last year. You have to file an amended tax return and pay the tax on it, right? So that change to depreciation expense is going to hit retained earnings. Would that also hit tax? Yeah. But where would the tax, if you had recorded the tax properly last year, the tax expense higher in that case, where would that tax expense get close to? Retained earnings. So both the depreciation and the tax effect on it are offsetting. They're in retained earnings. They'd be offset, but they're in retained earnings, aren't they? Right? Got the idea? So the whole adjustment goes to retained earnings. This is correcting an error. What's a change in estimate? Change in estimate is I estimated as good as I could. It will be adjusted journally, but so would a prior period adjustment, right? Okay, so would a correction of an error. But the thing with the change in estimate is I made the best estimate I could last year, and with hindsight, I should have made a different estimate, right? My estimate changes. So I estimated the life of an asset to be 10 years, and now I think it's 5 years. I don't go back and restate any of those prior years. I don't make a prior period adjustment for it. I made the best estimate I could at the time, right? So what I do is I reflect it in the current year and prospectively into the future. Do you see the distinction on this? Now, how do you tell a correction of an error from a change in estimate? That's interesting. How do you tell them apart? Here's kind of a joke, although I've read a study once that's kind of, they collected evidence, let's say, that this happens. If I'm the new accountant, either the new outside CPA or the new one inside, and I find something that was screwed up that somebody did before, that's a correction of an error. They made mistakes, right? That's a correction of an error. So I do a prior period adjustment. If I was the accountant last year, and I find something that was screwed up, well, I did the best I could. It was the best estimate I could make, so now it's a change in estimate. So the current year prospectively in the future. It kind of sounds like human nature does. You made a mistake if you were the old accountant. But if I was the old accountant, that's not a mistake. It's a change in estimate, right? Okay? So, and don't let yourself fall into that one, right? You separate it. But this is a judgment call, isn't it? What is it? Okay. What do you have both? The prior period adjustment comes with a change in estimate. It's one transaction. You think it's both mixed together. Go with the prior period adjustment. Okay? All right? Here's the thing, though. Could people intentionally overstate income in a year, right? Kind of fraudulent, right? Do it. Material misstatement in the financial statements on purpose, right? Do it. And then the next year do a prior period adjustment to correct for it. Okay. Got the idea? And you never have to run the loss through your income statement. It goes straight to retained earnings with a prior period adjustment. Don't let your clients pull that one either. If year after year after year you have a retained earnings adjustment, reducing your retained earnings, give me a break. Right? There ought to be mistakes that are against you, not just in your favor, right? Like that. Okay, so yeah, I think that one happens too. So what does retrospective adjustment mean? You go back and change the years that you're showing comparatively. Okay? All right. So cumulative effect adjustment to beginning retained earnings, approach reserves comparability across years. Now this can be errors and accounting changes. So accounting changes is what? Change in accounting principle. When you do a change in accounting principle, it looks just like a correction of an error, but it's not one. Everybody hear that? On the CPA exam, change in accounting principle is different than a correction of an error. Correction of an error is correcting a mistake, right? Change in accounting principle is gap change, right? Either there's a new FASB, so now you're following a new FASB instead of the old one, you have a change in accounting principle that's forced upon you, or you decided to switch from one generally accepted method to another. So I was using FIFO, now I'm going to use LIFO, that kind of thing, okay? And you have to think the new method's better than the old method, and you would disclose that you changed, right? And you disclose the effect of the change, all right? But this is how you show it, okay? So what we do is retrospective adjustment, which means what? Restating the years you're showing. Okay, so if I'm doing 3 years comparative statements in a publicly held company, all 3 years get restated as it, well, the current year is using the new GAAP. The other 2 years are restated, the 2 old years are restated, right? As though I had been using it all along. You restate it, okay? And you adjust the beginning retained earnings at the beginning, right, of those financial statements, that set of financial statements. Your journal entry really just goes to retained earnings at the beginning of this year, right? That makes sense. And then you just go restate the prior years. Because remember, you already closed those revenues, right? Close the revenues and expenses. Okay, so examples, going from FIFO to something else, or from something else to FIFO, average that they give you. And then change the percentage completion method to completed contract for construction companies, that kind of thing. So they say companies can change principles, but they must demonstrate that the newly adopted principle is preferable to the old one. Such changes result in lost consistency from period to period. And by the way, if you're doing the audit, you would have one sentence that says that they're not consistent. Statements aren't consistent. And then you probably refer to the note in the financial statements where they explain what they're doing and why they're doing it. Okay? So we assume consistency otherwise. So here's just a real simple example. They show what income would have been under FIFO for each year, what it is under weighted average for each year, and what the difference is. And so what they're doing is they're going and they're restating their income for each year, and they just show it. I don't know if it's all that wonderful. But they show you change all 3 years. So that's fine. Okay, change in accounting estimates. So now we're to the estimates. So that was an accounting change or a correction of an error, which is a prior period adjustment. Let's get together, right? Okay. Show the prior period adjustment first because you're adjusting the beginning balance, and then you show the changes in accounting principles statement second. Okay, they show you that in chapter. Change in accounting estimates are accounted for in the period of change or in the period and future periods if it affects both. So we'd say in the current period, prospectively, if you change the depreciable life, let's say I was depreciating the asset $10,000 a year, right, for its first 5 years, and that was too much now with hindsight. It should have only been, say, 70 years. But I've done 3 too much each year for the first 5 years, so I'm 15 ahead. What I'll do is I'll just reduce the depreciation for the remaining life, okay? Same thing, okay? So I just have much less in the future, okay? And we'll use that look like that. Okay, so what we do is the examples, useful lives and salvage values of depreciable assets, allowance for uncollectible receivables. Right, I made the best estimate I could for allowance for doubtful accounts, and it turns out not to be nearly enough. I have 100,000 allowance for doubtful accounts. We write up 150. Now I got a 50,000 debit balance in the allowance, right? Starting the next year, what's going to happen? I have to credit the allowance for 50 before I put anything in this year, don't I? I have to debit bad debt expense for 50. You didn't just get back to zero. I don't go back and restate the prior years when I, with hindsight, didn't have enough allowance. Made the best estimate I could. I put it all in the current year. Everybody got the idea how this is working? So allowance for doubtful accounts can really do you in token warranties. If you don't allow enough, what happens? You didn't have enough expense, you have too much net income with hindsight, and it screws up the next year. It just does. You have to catch up, right? Okay? And by the way, you should catch up all at once. You should say, oh, well, we'll pay it again over 10 years. You're going to let your allowance be too little for the next 10 years while you catch up? No. That's smoothing. Right? No. You got to go ahead and take it. Right? Take the hit. And inventory obsolescence. Right? Another example. Okay, so here's an example of change in estimate. Okay, they purchased equipment for 510. No, this is the one I was trying to do off the top of my head. Which was estimated to have useful life of 10 years, a salvage of 10. So we're going to have 500,000 spread over 10 years. Then recorded 7 years on straight line. So in year 8, it's determined the estimated life should have been 15 with a salvage of 5. So we do the journal entry, right, and then calculate to correct the prior year's depreciation to calculate the depreciation expense for the current year. So here it is. Everybody see that? 510 less the 10 salvage. Depreciable base is 500,000. Useful life 10 years. It was 50,000 a year, of course. 7 years. I've got accumulated depreciation of 350. So you can see that equipment was 510. Accumulated depreciation is 350. I've got a net book value of 160. All I have left to depreciate possibly is 160, but I'm going to still have a salvage of 5, aren't I? So they subtract their salvage of 5. I got 155, and now there's 8 more years left because I extended the life from 10 to 15. So they were depreciating 50,000 a year. I don't go back and change any of that, but I'm only going to have 19,375 for this year and each year into the future. Everybody got it? Okay. So for this year, debit depreciation expense 19,375, credit accumulated depreciation 19,375. Just rolls into the future. So I'm doing the best I can with it, basically. What's the retained earnings adjustment going to look like? What happened? There's not one, right? Why isn't there one? I don't go back and restate. Everybody got it? You guys handle it? Okay. How to handle a change in estimate. Now this is an accounting error. Math mistakes, mistakes in application of GAAP, I violated GAAP. Overuse or misuse of fact, oversight or misuse of fact. I should have known, but I didn't know. I made the best estimate I could, or if I'd gotten more information, I could have made a better one. Sort of the judgment call on. So you got to decide, okay? Corrections are treated as prior period adjustments. Adjustments to beginning balance. So here's an example. They determined you incorrectly overstated accounts receivable and sales, right? So assets are too high, and income is too high, and retained earnings is too high. They say to ignore income taxes. Of course, you'd never do that. So let's consider income taxes when we do it. There it is. That fixed it. Okay, 40% tax bracket. What's the journal for doing the taxes? I just put on my income statement, or on my tax return, what did I do when I went back and revised the tax return?
100 out of.
I took 100 out of taxable income. I mean, a 40% tax bracket. How much taxes is that going to save me? 40,000. The government's going to send me 40,000 back, right? If I do an amended return. Everybody got it? Okay. Even though literally it's just deducted from the five for that year's taxes. Okay. Government owes me 40,000. Okay, because I overstated my income on my tax return. Everybody got it? Okay, so there is a tax impact of this. So tell me what that would do. What would that do? What would it have done if I found it last year? What would I have debited and what would I have credited? If I had realized I made the mistake last year, I would have debited sales and I would have credited accounts receivable. And there would never have been a mistake, right? I'd have had just less income. But what would I have done with the taxes last year? I had less income units. How would I fix that? I would have reduced tax. How? What do you mean? Credit tax expense by how much? 40. So I would have credited tax expense by 40 and I would have debited what? What do I reduce? Well, no, tax what? Tax payable. I would debit tax payable and I would credit tax expense, wouldn't I? Everybody agree with that? Or debit receivable from the government, but I already paid the taxes, I guess, right? Tax refund receivable. But it'd be debit tax payable and credit tax expense, wouldn't it? Yeah. Okay, so how would I fix it now? I would have closed the tax expense to retained earnings, but the tax payable would still be there, wouldn't it? So what would I do next year, this new year? Yeah, I debit retained earnings instead of sales, right? Because sales got close to retained earnings. And I credit accounts receivable, get them down where they should be. What do you want to debit? Tax payable for 40, and what do you want to credit? Retained earnings, because tax expense would have been close to retained earnings, right? It's retained earnings. So both of them are retained earnings. I don't know why they did it in that tax. That's stupid. What I would have done here is debit tax payable by 40, right? Assuming a 40% tax rate, right? Debit tax payable by 40, credit accounts receivable by 100, and debit retained earnings for how much, guys? 60. After tax. It is after tax. Everybody got it? Okay. And by the way, could it be increasing retained earnings instead? Sure, if the year went the other way. Right? No big deal. These are not hard. Oh, and they didn't show us the disclosure, but they did in the book. The beginning balance and retained earnings adjusted by, right, the prior period adjustment. It's the first item. Then after that, you show the current year net income less the dividends. Right, guys? Okay. What if you have a cumulative effect of a change in accounting principle? Beginning retained earnings, plus or minus any prior period adjustment, then the cumulative effect of the change in accounting principle, right, goes in there. Everybody good? And then your net income and then your dividends. Okay, so here's another great chart on page 4, or illustration 422. Changes in accounting principle, changes in estimates, change or corrections varies. So the three categories. By the way, notice they say show net of tax, show net of tax. on the correction of an error hits retained earnings, the change in accounting principle hits retained earnings, right? Oh, by the way, on the change in accounting principle, you restate the years that you're comparing, right, guys? You don't restate for either of these, do you? Okay? And how about for future years? For future years, I would use the correct gap if it's a correction of an error. For future years, I'd use my new estimate, right? If it applies to future years. And if it's a change in accounting principle, for future years, I just use the new gap. But that's all before tax, right? It's not getting a retained earnings statement at all in any of those cases. Okay, so everybody good with these? We beat it to death, I think, pretty much. Good, with happy people to handle these, work some problems. Okay, get some examples. Okay. These are kind of obvious, you know this, right? Net income. Yeah, changing accounting principles on both sides, prior period adjustments on both sides, of course. Okay, net income, net loss. Okay, where's dividends? Oh, there they are. Yeah, that's kind of obvious. They're showing me adjustment. Whoa. This is an error. Oh. I don't. Go away. Okay. Here. So they're showing error correction for prior period adjustments. Here we go. Here's an example. Immediately below the opening balance, right? If you have a prior period adjustment, either increasing or reducing. And that would be net of tax, when you put in parentheses, net of the tax impact, right? Either a tax reduction or a tax expense. Everybody good? Okay, restated. And then they would show, oh, don't do that. Okay, well, here they show it. They show the net income, the dividends, and the balance. Lovely. That's the order it goes on. You're going to see the early again. Isn't that weird? Why'd they do that? I have to click over on the side, do you think? All right, appropriated retained earnings is, oh, and then restrictions on retained earnings in the notes, right? Appropriated retained earnings is easy to say. You got to hopefully go under this. Regular retained earnings is unappropriated. What does appropriated mean? What? That it's restricted in some fashion. But it doesn't mean set cash aside, or any assets aside, or anything not. It's communicating to shareholders that you're not going to pay dividends. Right? We are appropriating our retained earnings or restricting them for some purpose, right? So I might have big retained earnings, and shareholders may be wondering why I'm not paying a dividend. So what I do is I appropriate retained earnings for retiring a bond, right? I plan to retire a bond. So I need to keep a whole bunch of my assets around to retire the bond. So instead of restricting the asset, you restrict retained earnings, and you can have your assets be wherever you want them to be, right? In cash or in receivables or whatever, okay? That's the kind of thing. Or maybe you're planning a plant expansion. So you're going to use your resources to do a plant expansion instead of paying dividends. You're going to reinvest instead of paying it out, right? Everybody get the drift on this? So I want to communicate this. So let's say I have $5 billion in retained earnings, and I want to set aside $1 billion of it effectively and let people know I'm not going to give dividends. No kidding. Here's what you do. You debit unappropriated retained earnings, regular retained earnings by $1 billion, and you credit appropriated retained earnings $1 billion. And you tell people in the note, and maybe even on the face of the statement, appropriation for plant expansion or appropriation for bond retirement. Got the idea? And you still show it as retained earnings in your equity statement, and your total retained earnings didn't change. Key thing is, question again, how many assets did they set aside when they did that? None. None. It's just communication. Okay, and it's fine. It's okay, so that's appropriated retained earnings. Okay, lovely. All right, and then comprehensive income. Okay, all changes in equity during a period, I don't know why I'm looking at the clock, you guys don't believe anyway. All changes in equity during a period except those resulting from investments by owners and distributions to owners. We already do that, didn't we? You guys memorize that? Right? All the changes, that includes net income, that's comprehensive income. Other comprehensive income, you have to take that income out of, right? Out of that definition. Anyway, it includes all revenues and gains, expenses or losses recorded in the income statement, all gains and losses that bypass net income but affect stockholders' equity, right? That's the other comprehensive income items. What are those on primarily? Securities, sales or sales securities, right? Gains and losses. What else? Foreign currency where you have not actually done the translation. That's changes of value on the foreign currency. And the other big one, pensions. Okay, those are the three big ones. Okay, so yeah, you go straight to equity. So GAAP and IFRS are now converging with respect to comprehensive income reporting. Okay, working on that. So here's your income statement plus the other comprehensive income, unrealized gains and losses on available securities, translation gains on foreign losses in foreign currencies, plus others, mostly pensions. Okay, so and that's reported in stockholders' equity. That part is. Okay, gains and losses that bypass net income but affect stockholders' equity are referred to as what? Other comprehensive income. Comprehensive income would include the net income. That was real hard when you were learning it, one whole chapter ago, right? Now it's a piece of cake, right, guys? Knowledge is building. Okay? Companies must display the components in one of two ways. A single continuous statement, the one statement approach. Nobody does it. Okay, so that's what I'm talking about. Two separate but consecutive statements of net income, and one with regular income and the other comprehensive income. It's two-statement approach. Why do we have other comprehensive income? Because people didn't want to include it in their income statement, right? That's political compromise. So why would they put it on their income statement? No, they don't want it. So they show separate statements. Really, a lot of companies just seem to show it in their equity statement. And technically, they're supposed to show both. So here's an example, right? Here's the one statement approach. Real simplified income statement, but here's their other comprehensive income down here. Like it? But what number jumps out at you? The authors are right about this. What number jumps out at you? The comprehensive income. So if you want to emphasize this number, whoops, no, I did it. If you want to emphasize this number instead of this number, what should you do? Probably put it on two separate statements, and that's what most people do. And they don't put them on the same page either. They're two separate statements, right? Different page. Okay, there it is. So there's your income statement, real simplified, but there's your income statement, and they start with net income and go down to comprehensive income. And of course, you might have more than one item. There's an unrealized gain on net of tax on holding gain. That's unavailable stock securities. Could you also have something related to pensions and something, if you have one? You have to have a defined benefit plan for related to pensions. So, and then you'll learn about that later too. Or translation gain and loss. You could have all of them. So you could have more than one line. And then on the equity statement, you have to show the column for that, okay, for other comprehensive income. So our equity statement gets more complex. Reports and changes in each stockholder's equity account and total equity for the period. Start with beginning equity, work your way down to the end for each category. So we're going to show the issuance of shares and distributions, dividends to the owners, also buying back shares. There's treasury stock, you have a column for that. Reconciliation and carrying amount of each component of stockholders' equity from the beginning to the end. And then you put the ending balance to the balance sheet. So each one of the categories, the ending balance goes to the balance sheet. Beginning balances come from last year's balance sheet. And here's what it looks like. You got a total either over here or maybe over here. Beginning, right, for all of the accounts. Again, if we had treasury stock, we'd have it in there. You'd probably have additional paid-in capital and common stock. You might have preferred stock and additional paid-in capital and preferred stock. This statement is real long, okay? Getting a couple pages wide, right, in an annual report. So anyway, there's the beginning. Net income affects, of course, retained earnings only. Other comprehensive income affects just other comprehensive income. Issuing new stock would come out over here, right? Retiring stock would also come out in here. And got the idea? Pretty straightforward. Okay, and there's the balance sheet. Common stock, retained earnings, accumulated other comprehensive income. My principal students, I told them today that I lied again. I lied twice. Did it with you guys too. Once when I said there were only 5 accounts, it's worth 10, right? Just contra everything. And then also, I told them whatever that is. It's weird. It's kind of strange. So, all right. So, take a look at the IFRS stuff too. There's a few more slides about the IFRS difference between IFRS and US GAAP. So it's borrowing money, you go on vacation. Live off your girl.
No, I don't think currently.
Nah, that's bad. Get a different coat. Good advice. Anyway, I probably should record that. It's good.
You don't have it ready until Monday?
I'm fired.
Huh? You don't have it for Monday?
I don't think so, do we?
This Saturday.
Sounds good to me. I don't